Hello and welcome to Portfolio Matters Weekly Update, week 101. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Before we get into it, just a reminder that we're still in the disrupted holiday season and normal service will resume next Friday. The next weekly will be next Monday when I return from skiing. But again, it will be a brief summary. Okay, news this week. So today, the Bank of England chief economist Hugh Pill gave a hawkish speech in Washington in which he said that the Bank of England was very much not done raising rates. And he said that the UK faced an almost unique set of inflationary pressures, including pricing power of firms, tight labour markets, and the energy crisis. And as a result, UK gilt sold off again. We also had US non-farm payrolls this week, and they were better than expected. The US created 223,000 jobs in December, although wage inflation slowed to 4.6% year on year. We will go through all that data in due course. We also had US ISM manufacturing and non-manufacturing data, but the most interesting aspect was the non-manufacturing survey, which fell sharply in December and portrays a US service sector which is going to enter recession. Finally, China lifted quarantine rules for inbound visitors after 3 years. So China is slowly reopening. Some charts relating to the news. Well, this is China's official new infections per day. And you see they're running about 100,000 a day. Well, separately, Italian authorities have stated that over half of the passengers arriving from China into Milan tested positive for COVID. So there seems to be a big discrepancy between the relatively low number of infections that are being reported by Chinese authorities and the extremely high infection rates that are being observed on flights out of China. Now, last Friday, we had a sharp fall in US Treasury yields, and that was caused by reassuring wage data on the non-farm payrolls. But the big drop was caused by the ISM non-manufacturing survey. We'll show you the data in a second. And that portrayed the US economy moving towards recession. And finally, this is subway use in China. And you'll see it seems to be recovering from the COVID-related drop early in December. So on to this week's economic data. And there was lots of interesting stuff. So in the UK, we had the British Bankers Association mortgage rate for December. Now, it was expected at 6.0%, which had been up slightly on November. It massively missed that. It came in at 6.4%. Now, reminder, up until last year, the average mortgage rate was around 3.8%. So you're seeing massive increases in mortgage rates. And most mortgages in the UK are 2 to 5 year fixed or variable. So that will feed through quite rapidly to mortgage holders. And as a result of rapidly rising mortgage rates, mortgage approvals fell sharply in November. So they're expected at 56,500. They came in at 46,000, well below expectations. Mortgage lending, though, beat expectations. How you square those two numbers, I don't know. We also had Halifax house prices for December, and bizarrely, the consensus was they were expected to bounce back and be up 0.4%. In fact, they fell by 1.5%. Year on year, House price inflation in the UK is at 2%. That massively beat expectations and is falling rapidly. We had UK construction PMIs, and having been surprisingly resilient throughout much of the second half of the year, construction PMIs fell below 50, again missing expectations. In the EU, construction PMIs were expected at 46.5, so already in contraction territory. They came in at 42.6, which is bad. The construction sector in the EU is not doing well and is in deep recession. We also had Eurozone inflation numbers, and these were good. So Eurozone inflation in December was expected at 9.8%. It came in at 9.2%. And month on month, we had deflation of minus 0.3%. So prices actually fell month on month in the Eurozone in December. Core inflation, so excluding food and energy, rose, however, from 5% to 5.2%. So that portrays a Eurozone economy with persistent inflation, and the ECB will need to raise rates to get it under control. We also had a lot of US data. So we had the ISM manufacturing survey, which I won't go through in detail, but was generally disappointing. We had the headline PMI fell again and is 48.4, so is in contraction territory. What's surprising is despite the fall in the manufacturing PMI, manufacturing employment actually rose in December. It was expected at 48. It came in at 51.4. So despite manufacturing PMIs, which portray a slowing manufacturing sector, manufacturing companies are actually positive on the outlook for employment in the sector. And new orders came in at a disappointing 45.2. So manufacturing companies are pessimistic about new orders, but they seem to be willing to hire more people, which is surprising. Manufacturing prices came in at 39.4. So manufacturers are expecting to pay substantially less for their inputs in the future. Okay, on to the non-manufacturing sector. And this is where we had a big, very disappointing numbers, and the market took it badly. So in November, non-manufacturing PMI was 56.5, which is in decent expansionary territory. It was expected to slow slightly to 53, came in at 49.6, which shows that the US non-manufacturing sector is now slowing. Any number below 50 is contraction territory. The employment number also missed expectations and came in at 49.8, again in contraction territory. The new orders collapsed. In November, 56. In December, 45.2. So that shows a non-manufacturing sector where new orders have dropped substantially in December. Prices paid missed expectations, and that's a good thing. So they came in at 67.6, down on November, slightly missing expectations, but still well above 50. So inflationary pressures in the non-manufacturing sector are fading, but are still strong. We also had the US Establishment Survey, and that showed non-farm payrolls grew by 223,000 in December, which slightly beat expectations, but was down on November. The US economy continues to create jobs. The participation rate ticked up to 62.3, beating expectations, which is good news. Hourly earnings missed expectations, so they came in at 4.6% in December, down on November, and missing expectations, and that is good news. Further signs that inflationary pressures are fading in the US. Average weekly hours missed expectations. Now, that is a very interesting number. So, the number of hours worked is dropping, and that is a good indicator of an imminent recession. We will show you the chart in a minute. But despite an increase in the participation rate and slowing manufacturing and services sectors, the unemployment rate fell to 3.5% from 3.6%, and that again beat expectations. It was expected to rise to 3.7%. So the US labor market continues to be tight, and that means that in order to get inflation under control, the Fed will have to keep on raising rates. Okay, some charts. So this is UK consumer credit, and you'll see it rose sharply in December. Now, is that financially stressed consumers turning to their credit cards? And this is the British Bankers Association mortgage rate, and that is rising very quickly, and that will kill the UK housing market if it hasn't already done so. And you can see that mortgage approvals in the UK are collapsing. And thank you to Richard Wilk for sending us this. This is loan approvals by type, and you'll see that approvals for house purchases and remortgages are both collapsing. And UK Halifax House Price Index has been falling now for 4 months in a row. And year on year, it's falling quickly towards zero. And I'd expect UK house prices to fall next year, and that would be the first time they've fallen year on year since, is that 2011, 2012? And you'll see that generally house price inflation in the UK is positive. It's only rarely that it dips negative, particularly after the great financial crisis. This is UK mortgage lending, which despite the fall in applications actually rose. Not quite sure how to interpret that. Moving to the EU, this is EU CPI inflation, and that has started to come down, but it's still very high. Month on month, it was negative. That's good news. Core CPI is continuing to climb, though. So the ECB will need to raise rates to get that under control. Construction PMIs in Europe continue to fall. And moving on to the US, this is construction spending in the US month on month in November, despite rising interest rates and rising mortgage rates in the US, construction spending actually ticked up by 0.2% month on month. The US construction sector is showing surprising resilience. New car sales in the US fell in December and really are nowhere near pre-pandemic levels. US job openings fell slightly in November, but still remain very high. There are lots of job openings. Moving on to the ISM manufacturing survey, this is the headline PMIs, is steadily declining and is now very much in contraction territory. New orders fell again into contraction territory. Prices paid is now indicating deflation, and the non-manufacturing PMI, and this was the shock number, collapsed in December. Now, previously, we had talked about the difference between the S&P Global Services PMI, which was portraying a services sector in the US which was already in contraction, and the ISM non-manufacturing PMI here, which up until December was showing a non-manufacturing sector which was still expanding and doing okay. Well, I think we have a definitive answer on which one is more likely to be correct. The ISM is falling to be more in line with the S&P Global Services PMI, which is here. And you'll see the S&P Services PMI has been portraying a weakening US service sector for some months now. But non-manufacturing employment seems to remain fairly stable. Then non-manufacturing firms do not appear to be cutting staff, even though new orders absolutely collapsed in December. Prices paid remain elevated but are falling. This is a chart from John Authors at Bloomberg, which shows the manufacturing sector in the US overtime hours. And you'll see that overtime hours are being cut back sharply. And whenever that has happened previously, that tends to be a precursor to recession. This is US non-farm payrolls, and decent number in December, another 223,000 jobs created in the US, although the unemployment rate remains low. So the jobs market in the US is tight. Participation rate ticked up a tiny bit, but remains very much below pre-COVID levels. And average hours worked, according to the non-farm payrolls, again, is declining. That also portrays a weakening economy. Average hourly earnings year on year fell slightly to 4.6%. And there was other good news in the jobs report, in that the wage growth data for both October and November, which is the light blue lines, were revised down. And so the establishment survey now thinks wage inflation was not as high as previously reported. So that adds to growing evidence of falling inflation in the US. This US 30-year mortgage rate, which has ticked up again. And this is the US MBA Mortgage Market Index. And this is a measure of all different types of mortgage applications. Please pause and have a read of the description I've included on the screen. And what it's showing is there has been a collapse this year in mortgage applications of all kinds. So in summary, the US ISM non-manufacturing survey was unexpectedly weak and depicts a US service sector which is slowing rapidly and is joining the manufacturing sector in pronounced slowdown. In particular, there was a huge drop in new orders. Now, previously, we've talked about the difference between the S&P Global Services PMI and the ISM non-manufacturing PMI, and it seems that the S&P Services PMI, which has been portraying a weak service sector for some months now, is more likely to have been accurate. And all that data portrays a US economy which is slowing towards recession later this year. The US labor market remains tight, though, so the Fed may have to raise rates higher for longer to create some slack in the economy. We have more on the US jobs report in a bit. Okay, on to one chart. So this is fun. This is the chart showing Sir Isaac Newton's purchases of stocks during the South Sea bubble between 1718 and 1721. Now, the South Sea bubble is a bit too complicated to go into here, and all you need to know here is it's famous for the flimsiness of the proposed companies and their economic basis. Famously, there was a company that proposed to do some business, but nobody is to know what it is. And the entrepreneur behind that particular bubble stock raised some money and then promptly skipped to Amsterdam. Everyone was getting rich on speculation in small companies, mainly aiming to do trade with South America. So early on, Isaac Newton invested. He practically doubled his money, which is great. and then he got out. But then the stocks continued to rise, and he began to get jealous of everyone around him still getting rich. And so he re-entered with even more money, and the bubble then burst and he lost a lot of money. The analogy, of course, is with ARK and with the meme stocks and the latest technology bubble. There have been loads of bubbles since the South Sea bubble. I lived through the dot-com bubble, and it was just as ridiculous. So, in summary, investment bubbles can expand further and last longer than you might expect. Always be aware that in order to realize your profits, there has to be someone willing to buy the stock from you. So sell at the first sign of trouble, and once you've sold, don't get back in. Investing in the bubbles can be lucrative as long as you maintain sell discipline and never become a believer. And this is particularly relevant to crypto, I would say. Famously, Sir Isaac Newton commented, "I can calculate the movement of stars, but not the madness of people." Okay, on to Inflation Watch. And we had some data from the EU this week. So Eurozone CPI fell to 9.2%, still way above the 2% target. Core CPI ticked up to 5.2%. In Germany, inflation fell to 8.6% in December, but core CPI in Germany was stable at 5.0%. So one of the reasons that Eurozone inflation is coming down, but core inflation continues to rise, is that core inflation excludes food prices, and food prices are starting to fall. This is US food CPI year on year, and the red line is fertilizer prices year on year. And you'll see fertilizer prices have collapsed, and you would now expect food prices to follow. So if food prices maintain their traditional correlation with fertilizer prices, we could now see rapidly falling food prices, and that'd be great for inflation. So this is the UN Food Price Index, and having spiked in 2022, it ended the year flat. So food prices well down from their highs, and food inflation should come down sharply in the coming months. During the pandemic, M2, the money supply in the US, grew by an enormous 25%, and you will have seen that inflation rapidly followed. Now, if inflation is a monetary phenomenon, then M2 annual growth is now at 0. And so inflation should also collapse. Let's see. And US apartment rents are now falling month on month due to falling demand. Demand for apartments in the US has turned negative for the first time since 2009. And this is German CPI. It's ticked down, still a long way above 2%. Really, it's not that long ago Germany was struggling to get 2% inflation. Month on month, it fell really very substantially, about minus 0.8%. Core inflation was flat month on month. Now, in the US, consumer inflation expectations are continuing to fade, but are still at 5% for the coming year. So some way to go for the Fed to get US inflation expectations under control. Back to the Eurozone, inflation appears to have peaked throughout the Eurozone. It's now just a question of how quickly it will come back down towards target. Reminder, and I'll show you the chart later, energy prices in Eurozone are coming back down very quickly. So in summary, inflation appears to have peaked everywhere. Goods inflation in particular is falling rapidly. The question is now how quickly core inflation will come down. That depends on wage inflation, and everywhere labor markets are tight. And I've got a bit more on that in a while. Okay, on to recession watch. So we've previously talked about how temporary worker numbers are a good leading indicator for recession. They are the easiest workers for a company to hire and to fire. And so the number of temporary workers tends to fall just prior to a recession. And on this chart here, you can see the grey bars are recessions. And in the last few recessions, there's been a pronounced fall in temporary workers just before the recession. And now the number of temporary workers in the US is starting to fall. Okay, and turning to manufacturers, well, everywhere, orders minus inventories are falling. So that means that inventories are building, new orders are falling, manufacturers are likely to cut their production further, and a manufacturing recession is likely. Reminder that the two sectors which lose jobs going into a recession are manufacturing and construction. And these are German new orders. That shows a steady decline. Global manufacturing PMIs are now below 50 and falling. So global manufacturers are pessimistic about the future and see contraction. And all sectors of manufacturing PMIs, that's consumer goods, intermediate goods, and investment goods, are now at or below 50. So it is a generalized slowdown. This is another example of why there is a slowdown in manufacturing. This is US imports of consumer goods. You'll see that they rose very strongly during and after the pandemic as US consumers were spending the fiscal largesse given to them, but they are now collapsing back down towards pre-pandemic levels. So that means global manufacturers have to produce less stuff. Okay, so in summary, the number of US temporary workers is starting to fall. This is normally a good sign of an approaching recession. Global manufacturing PMIs are uniformly negative. It looks like a global recession is likely during the coming year. And now on to the business cycle. And this is a chart we show you quite regularly, and this is from Fidelity, and I agree that this is where we are. So I think the UK and Eurozone are just entering recession, and the US is heading towards recession, but not there yet. And this is a diagram we showed you last year, and it is Merrill Lynch's investment clock. And it shows where they think you should be investing your money according to where the economy is. And I would say we are in slowdown, heading towards recession. Now, the trouble is that this economic cycle is not normal because we have much higher inflation, which means that the Fed is continuing to tighten rates when the economic data show a weakening economy, and the US should actually be starting to cut rates now to protect the economy. As it is, the US will keep raising rates to ensure inflation comes down. So they are prioritizing the fight against inflation over their competing duty to maintain employment in the US. And hence, I put the green arrow pointing towards short-term treasuries. I think it is too early to start moving into defensive sectors, long-term treasuries. any risk. The safest place to be at the moment is in cash. And this is another chart showing recommended investment allocations for different stages of the investment cycle. And I would say we're now in low economic activity and declining inflation, although inflation is still high, but it's declining. And so they would recommend nominal bonds, investment grade corporate bonds, and the US dollar. But right now, that trade is not working because interest rates are still rising. When they start falling, bonds should do well. Okay, so in summary, the world economy is slowing. Europe and the UK are likely to be in recession already. The US is slowing towards a recession in H2. Now, normally, because the US economy is slowing, the Fed would be starting to cut interest rates, but the US labor market remains very tight. Inflation is strong, and the US is intent on continuing to raise interest rates, and that makes this an abnormal cycle. And I had previously assumed it was a normal cycle and started buying bonds, and I've been wrong, and it's cost me money. I would therefore say it's wiser to wait for the Fed to pivot before starting to buy bonds. The safest place to be at the moment is in cash. And when will the US start to cut rates? Well, this is the market's expectations for US interest rates over the coming year. And you can see they're expecting rates to rise strongly at the end of January, which is the next FOMC meeting, but then 2 further rises to May, and then rates to start coming down. So I think it's best to wait for a few months before buying bonds. Okay, on to Chinese household debt. Now, the yellow line is US household debt to income. And you see that it hit a peak of around 130% of GDP just prior to the Great Financial Crisis, and it's then been coming down. Now, the orange line is Chinese household debt to income, and you'll see that it has risen very quickly from around 30% of household income in 2007 to over 120% by the end of 2019. Chinese consumers are now more highly geared than US consumers, and the rate at which their debts have risen is historically unprecedented. And that is almost certainly due to investment in housing. So they've been taking on big mortgages to buy property. And now that the Chinese consumer appears to be approaching its credit limit, so banks have started lending to corporates instead, and their lending growth to consumers is declining. And all that makes Chinese consumers vulnerable to a financial crisis. So falling Chinese property prices and a slowing economy could rapidly feed through to Chinese consumer defaults and a widening financial crisis. Okay, onto the US jobs report. So the FT had graphs of each sector in the US jobs report. So let's go through them. This is construction sector, which continued to add jobs in December, which I find absolutely mystifying, given the fact we know house sales in the US are collapsing. This is employment and health services continuing to grow and now above pre-pandemic levels. Financial activities above pre-pandemic levels, still growing. Government jobs, big cuts during the pandemic actually, but since recovering. Now, one of the few sectors to lose jobs was information, i.e. technology. So the tech bubble is bursting. The leisure and hospitality industry has been struggling to get staff, and you can see it remains below its pre-pandemic levels, ticking up steadily. Manufacturing, surprisingly, given the collapse in new orders, is continuing to grow. Mining and logging up, other services up. Professional and business services, that appears to have peaked. Retail services has been going nowhere for a year now. Retail sector is not doing well. Transportation and warehousing has had a huge rise over the last 2 years because of supply chain difficulties and has been losing jobs for a few months now. Utility sector is essentially very stable. The scale on the lift rather exaggerates the volatility in jobs there. The wholesale sector continuing to add jobs. And this summarizes the situation. The picture is a very broad-based jobs growth throughout the economy, and only the white-collar information services and professional business services sectors losing jobs. Now, the labour force participation rate ticked up slightly in December, and that was good news. But some weeks ago, we talked about how the establishment survey was portraying a strong jobs market, whereas the household survey was not. And we then discussed how revisions to the establishment survey suggested that the establishment survey may actually be overestimating job creation in the US. However, the ADP survey, which is a private sector survey of 400,000 companies and shows their actual changes in their payrolls, shows that according to them, the US has been adding jobs steadily throughout 2022. And it suggests that the establishment survey is right. The US has been creating jobs over the period. And if we dig down into the ADP employment survey, you'll see that its picture is more nuanced. So some sectors such as trade, transportation and utilities and manufacturing have been shedding jobs, but others like construction and actually professional and business services have been adding jobs strongly. So in summary, the December non-farm payrolls showed that most sectors in the US continued to add jobs, and overall, there were 223,000 new jobs created in December. Surprisingly, the construction sector continues to add jobs despite falling home sales and very strongly negative construction sector PMIs. So the possible explanations of the discrepancy between the strong job numbers and the very weak PMIs could be that the establishment survey is wrong. The ADP survey tends to back up the establishment survey, and so I think that it's more likely the establishment survey is right and the US is creating these jobs. Or it could be that companies have been scarred by their experience during the pandemic when they fired lots of staff, only to find they've struggled to rehire them. And now they are still searching for staff, and they are not firing people and still looking to add to their headcounts. So the investment implications of that are the jobs market remains tight, and therefore the Fed will need to raise rates higher for longer to bring inflation under control. That's bad for short-term rates, bad for equities, and bad for all financial assets. But reminder, and thank you to our Discord member Tibster for reminding me of this chart. This chart shows how various sectors of the economy react to a recession. And so T0 is the start of recession. So the first sector to slow in advance of a recession is housing. And we've seen that new home sales in the US are collapsing, but the construction sector is strangely continuing to add jobs. And we know that there are record numbers of new homes and apartments that are under construction and still need to be completed. The second sector to slow is new orders, and we've seen that manufacturing and services new orders are collapsing, and those both happen in advance of recession. Then, contemporaneous with the recession, you get a slowdown in profits, and only after the recession has already started do you get a fall in employment. So, employment is a lagging indicator. Rising employment is perfectly compatible with an imminent recession. Onto the US participation rate. Now, I said earlier that the US participation rate ticked up in December. Now, the green line is the participation rates amongst prime age labor, so people between 25 and 54, and you'll see it's at 82.5, and that is pretty high. Its peak has been 83. So prime age workers are largely back to work, back to their historically high participation rates. The unemployment rate is low. It's ticked down this month to 3.5%. And all of that portrays a labor market that is very tight. The reason the labor market is very tight is that lots of older workers have left the workforce. So this is the number of workers employed in the US who are 55 and over. And you'll see there is a substantial drop during the pandemic, and those workers have not returned to the workforce. And a possible reason could be long COVID. Now, this is a chart from the UK, and it shows that during Q4 2022, 2.1 million people in the UK, that's 3.3% of the population, reported suffering from long COVID, one of the symptoms of which is fatigue. And although many of those people will already have existing conditions, some of them will have previously been in employment and will have fallen out of the labor force. So the implication of that is that going forward, those workers will not return to the labor force, that the labor market is likely to remain tight. And if we go into recession, then coming out of recession, the labor market will remain tight. And so wage inflation could continue to be an issue into the future. Okay, onto other charts. During 2022, Chinese property sales fell by 40%, and the sales of some developers, such as Evergrande, fell much more than that. Evergrande sales fell by about 90%. Now, we know China has provided stimulus to get these Chinese property developers to complete the flats they have started. But it's very much an open question whether China will be able to reflate the bubble. The analogy has to be with Japan. This is a chart of the balance sheets of all the central banks in the world, and you'll see that generally they are falling. Only the dashed line, which is China, is still rising. Turning to the US, the proxy fund rate in the US may have peaked. So real interest rates in the market have overshot the Fed funds rate and now may have peaked. And financial conditions in the US are easing, all of which actually makes the Fed's job more difficult. And after all that, some good news. Well, this is a European bison, and they have been reintroduced to Britain. So this particular bison has been reintroduced to a nature reserve in Kent The species were hunted to extinction thousands of years ago. So good news for European biodiversity. Apparently, they will disturb the soil and do lots of good things to it. Onto equity markets, and it was generally a very good week for equity markets. The all share was up 3.6%. The stocks Europe was up 5.6%. S&P 500 up 2.7%. NASDAQ up 3.1%. The Hang Seng was up an enormous 8.1%. So everywhere we are getting the traditional New Year rally. Topics, however, was down 0.8%. Bitcoin joined in, up 4.7%. Sterling was up 0.8%. Euro up 0.3%. The dollar index fell 0.4%. VIX declined 1.1% and is at 21.44. So the VIX indicator is very much more towards sell than to buy for the S&P 500. And this is the Hang Seng, and it's had a tremendous bounce since November on optimism about Chinese reopening. Equities have never bottomed before rates have peaked. And we know the Fed is committed to continuing to raise rates for a few months yet. So we're unlikely to have seen the bottom of this bear market. And even when the Fed funds rate has peaked, stocks tend to go sideways on average for a further 6 months. So it is way too early to be considering buying the stock market. Bear markets do not end after the initial Fed rate cut, only after significant rate cuts. The Fed tends to tighten too hard, inducing a recession, and then aggressive rate cuts are needed to turn the economy around. And this is a chart of the US trade deficit. And you see the trade deficit is shrinking. And that is good for the dollar. We've talked about this previously. As the US trade deficit falls, so the US has to spend fewer dollars to pay for those imports. And that means fewer dollars are available to the rest of the world to service their dollar debts. They then have to buy dollars to have the dollars to service their debts, and that drives up the dollar. Okay, onto commodities and energy commodities. And a very poor week for oil. Brent was down 7.3%, WTI down 7%, natural gas down 2.5%, though UK natural gas bounced up 2.8%. US natural gas continued to drift off, down enormous 8.6%. Coal up slightly, uranium flat. Some numbers pertaining to the oil market. So US crude inventories continued to fall. So the US oil market is structurally undersupplied at the moment. US crude production bounced by 100,000 barrels, up to 12.1 million barrels, which is the level at which it was at for most of last year. Baker Hughes rig count declined by 3. So the number of rigs in operation in the US has been falling for a couple of weeks now. And this is Brent. So we had a nice rally during December, and that is all unwound in the first week of January. This is a chart showing the balance in the oil market, and it's showing that now the oil market is actually in surplus. Now, we report every week the inventories in the US, and the inventories in the US are falling. So how can the oil market be in surplus when US oil inventories are falling? Well, it's because inventories in the Asia-Pacific region are growing. The danger is in reporting data on a weekly basis. We report the numbers that are most available to us for free, and those are the US numbers. Now, what appears to be happening is in Asia-Pacific, stocks are growing and we don't have access to those numbers. But you'll see from this chart Commercial crude stocks in Asia are much larger than in the US and Canada. S&P Platts is forecasting that there will be a small oil deficit in 2023. But I'd suggest it is very difficult to forecast because that all depends on the amount of demand destruction there is in the coming recession. When Russia invaded Ukraine, it was expected that the oil market would be very tight because of the effect of sanctions on Russia, leading to a loss of Russian oil supply on the international markets. Well, what appears to have happened is that there has been no loss of Russian supply. The Chinese have bought it all. Now, this is a bit of a messy chart as it compares two different things. On the right, it's European purchases of Russian energy in millions of barrels of oil per day. And on the left, in the red line, is Chinese purchases of Russian energy in billions of dollars. And you'll see European flows have been falling and Chinese payments for Russian energy have been rising. The fall in European natural gas prices now means that natural gas is once again cheaper than heating oil. So any marginal use of heating oil for power generation will cease. These are European natural gas futures. They have declined a long way, although they still remain much higher than their 2020 levels. And over the last month, there has been a huge drop in expected net European natural gas prices. So the orange line is the curve as of a month ago, and they were then expecting prices of around 140 euros per megawatt hour at the end of 2023. Well, 1 month later, they're expecting prices of around 80 euros per megawatt hour. So the market is much more relaxed about European natural gas supplies over the coming year. And the reason Europe has been able to survive the winter fuel crisis is because it's imported a lot of LNG. In 2022, it imported 101 million tons of LNG, up 56% year on year. And it was only able to do that because China imported less. So the red bars are the EU, and you'll see in 2022, there's a big increase in imports. The dark blue lines is China, and you'll see Chinese imports of LNG fell sharply in 2022. Now, if China were to attempt to resume its LNG imports at its 2021 levels, the market would be short supply. But it's likely the reason that China have cut back is because of very high prices. So this chart, and thank you very much to Discord member Legion 852 for sending me this shows you the changes in European electricity generation from 2021 to 2022. And you'll see that because of maintenance of the French nuclear reactors and also the Germans deciding they were going to close down their nuclear reactors, there was a huge drop in European nuclear electricity generation of 118 terawatt hours in 2022. Also, the drought caused a big drop in hydroelectricity generation. So that meant that we couldn't afford to reduce our gas usage for electricity generation. And despite record gas prices, we still used as much and a bit more natural gas than we had done in 2021. We also burnt coal and lignite, particularly in Germany, as they closed down their nuclear fleet. We added onshore wind and solar, but the balance was made up by demand destruction. So overall, we reduced our electricity generation in 2022, and high electricity prices caused people to use less. Now, the good news is the French nuclear fleet is coming back online, hopefully, as maintenance ends. The Germans have actually extended the life of some of their nuclear reactors. We are having a wet winter here in Britain, and if there is no drought next year in Europe, then hydroelectricity supplies should come back on at normal levels, and that should mean that we will be able to reduce our gas consumption, which means gas prices should come down, energy prices should come down, inflation comes down, and the EU should not have an energy crisis. This is UK natural gas futures, had a bit of a bounce, but well down from their highs. US natural gas futures down, coal flat, uranium flat. On to industrial commodities, and very much a mixed week. Aluminium down 3.4%. Cobalt finally moved, and it moved sharply, down 6% on the week. Copper bounced in the opposite direction, up 6% on the week. Iron ore continued to drift higher. Lithium is fading, down 5.6%. Nickel also dropped sharply, down 6.6%. Zinc bounced up 7.1%. Some charts. This is aluminium going nowhere. Cobalt, very illiquid, but is now falling. Copper, good New Year's bounce on optimism. Will that last? So this is a chart of how much copper is needed for the energy transition by 2040. And you see that they're saying consumption will go from 28.8 million tons in 2020 to 55 million tons in 2040. So that is almost double current consumption. Copper is going to be in very big demand, and we don't have enough supply, and this is very bullish for the copper price long term. Chromium flat on the week. Iron ore continues to drift up. Is the iron ore market telling us that the Chinese reopening and Chinese construction stimulus is going well, and the Chinese construction sector is getting back to work? Something to watch. Lithium drifting off. It's had a very good run. Neodymium flat. Nickel down on the week. Tin drifting back up. Ferrovanadium flat on the week, but has been following iron ore up. Zinc had a bounce. And on to precious metals, where gold had an amazing week, up 3%. Richard will be happy. Silver was down slightly. Platinum up 2.1%. So gold and platinum both had a very good week. Rhodium bounced slightly, up 1.2%. Palladium drifted off. And so gold has followed equity markets higher. It's acting like a risk asset this week. This is the gold price. It's had a very good run over the last month and a half. Silver, platinum, rhodium drifting off, palladium. And on to rates. Well, today we had a rise in the UK rates, particularly at the long end. So you'll see that over the course of the week, the UK short end actually fell by 14 basis points, but the 50-year rose by 6 basis points, and most of that was all today. And you'll see that UK long duration yields are higher than short duration yields. So the market does not think the Bank of England has raised interest rates enough to get inflation under control. So the market is currently demanding a premium to hold longer dated UK gilts. The UK base rate is currently 3.5%. If the 50-year is the average interest rate expected over the next 50 years, they're expecting UK interest rates to go higher and stay higher for a very long time. In contrast, the Greek 10-year fell by 15 basis points. The Italian fell by an enormous 45 basis points. And this is the US 20-year year-on-year change. And you'll see that it shows strong mean reverting tendencies. When it has had very sharp fall, it tends to bounce back. And let's hope that is the case this time. And this is the UK 10-year. It fell over Christmas, is now coming back up. This is the 30-year, hardly fell and is now climbing again. This is the US 10-year. Is that a decisive break to the downside? German 10-year also making a decisive break downwards. Italy, the same. Greece, the same. So you see, the UK is very different. UK 10-year yields are not coming down. The market is concerned about the outlook for UK inflation. Our view on various asset classes is unchanged. I won't run through that again. In a bear market, the seasonality chart says that there will be an early bounce to the market and then equities will drift off again. And I'm expecting that to be the case. So concluding comments, well, the data this week show the US service sector is slowing and a recession looks increasingly likely in H2. In the UK, we've had gilt yields continuing to rise, whereas in Europe, bond yields are falling. And that is a clear sign the market is concerned about the outlook for UK inflation. The Bank of England is going to have to raise rates higher, and that will tend to slow the UK economy further. The UK is likely to go into a bad recession. And finally, on to my portfolio. Well, I had a little bounce last week, which is the first time I've been up in some weeks, actually. But frankly, having looked at the fall in UK gilts prices today, I'm likely to be down today. So I've started the year, the first week, up 0.3%. Obviously, the FTSE had a very good week, so I am starting the year up in absolute terms, but very much down relative to the all share. I sold a bit of my UK cash ETF with a small positive return, and I couldn't help myself. I dipped back into the iShares US Treasury 20-year plus ETF, and we'll be adding to that as US yields start to fall. And I also added slightly to my position in the 2061 gilt. And frankly, I've got to stop doing that. It is not working. And I've got to show some patience. But the price seemed to have stabilized prior to today's sell-off. This is the iShares 20-year plus ETF. Is that a bottom? This is 2071 gilt, and that excludes today's action. Looked to be forming a bottom, so I added a bit. And this is today's action in the 0.125% 2068 index-linked gilt, which I own, and it's down 5%, which is very painful, frankly. And I have been very surprised by the further falls in long-dated gilts, and it's cost me a lot of money. Now, these index-linked gilts have a decent real return. So if we believe that inflation would average 3%, then you would get 3% plus a real yield of, let's say, 0.2%. I don't have the exact numbers because I don't have access to them. If anyone has a good source for the real yields on index-linked gilts, please can you share that with us? And that the 3% you earn on the capital, the inflation, is tax-free. Now, if you were to get 3% return on any other asset, you would have to pay 20% tax. So you would need to get a return of about 3.75% to match the 3% tax-free you're getting on the gilts. And as the price falls further, so the real return grows, and these become very attractive for higher rate taxpayers. This is the 2061 gilt, which I have been adding to. I've got to stop. Now, I have mistimed this trade, and frankly, today I'm feeling rather annoyed about it, as it's sold off yet again, and I have once again mistaken a temporary bottom for the bottom. Now, I have a history of getting the timing of these cyclical trades wrong, and I have talked about this in a podcast, My Worst Trade Kazakh Miss. This is the worst one, where during the financial crisis, I started buying the Kazakh copper miner Kazakh Miss at a price of £7.20. It peaked in 2008 at a price of over £18. So when I started buying it £7.20, I thought, well, how much lower can it go? It's fallen 60%. Well, it could go a lot further. I bought it again at £5.50, bought it again at £2.80. It then bounced, and I mistook that for the bottom, and it promptly fell again. I bought more at £2.12, and it bottomed at £1.80. And what's interesting is it then didn't bounce straight back. You had time to get in at the bottom, and if I had just been patient, I could have got in at much better prices. But then when it bounced on Chinese stimulus, which was my trade, I'd anticipated that the announced Chinese stimulus would mean a strong bounce in commodity prices. Well, when that happened, I sold the whole lot at an average of £12. So it was a good trade, but immensely painful. And what is frustrating this time is, again, I think this is the right trade, but again, I managed to completely mess up the timing despite doing this podcast every week and knowing a lot of the data. I have, in retrospect, it is clear to me that this is not a normal cycle, and I had assumed it was a normal cycle. Inflation is higher, and interest rates are going to have to stay higher to get inflation back under control. And the fundamental problem is that labor markets are tight, and inflation expectations have led through to higher wage demands. Now, in the coming year, I expect higher interest rates to lead to a recession. In the UK, we saw earlier that high interest rates are leading to very high mortgage rates, and the UK property market is just unaffordable when mortgage rates have risen from 3.8% 2 years ago to over 6% now, and there has been strong house price inflation in the meantime. The combination means that UK housing and US housing is now simply unaffordable. That will inevitably lead to falling construction and a recession, all in due course, and a recession should bring inflation down. But in the meantime, yields are continuing to rise, and I'm wrong and losing money, which is uncomfortable. Happy New Year, everyone. So on that cheery note, thank you all for watching. Please can you press like and subscribe to the channel. Reminder, next week I'll do a brief weekly on Monday, but normal service with Richard will resume next Friday. Thank you for all watching through to the end, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.